Sorry, I didn't
Yeah,
know
now
that this was an option.
think it works.
Yeah,
Yeah,
let me
now we
just
see the whole PowerPoint presentation, the whole window.
okay,
Okay, yeah, now it
cool,
works. Yeah, good luck to you.
right. So this, I think, I've already covered that. These are some of the areas that we covered in the initial two webinars, and now today, out of different DeFi use cases, we'll be focusing this webinar because there are a lot to discuss, cannot be covered in one webinar. So today we'll be discussing two major DeFi use cases. One is decentralized exchange, and the second is lending and borrowing protocols. So coming first, what is decentralized exchange? So we know most of the people who have owned crypto or bought crypto or traded in crypto, you're pretty much aware of centralized exchanges. So there are quite a few large centralized exchanges like Coinbase or Binance and so on and so forth. And you know how the process works in a centralized exchange. So you go to a Coinbase, you create an account, you do your KYC, and then post that there's an option where you deposit tokens. So you can deposit tokens or you can buy tokens in fiat. And once you buy the tokens, the token balances show into your account, but the actual tokens are held by the exchange as a custodian. And then you trade. So let's say you have bought 1 ether or you have deposited 1 ether, and then you can buy USDT against that ether, or you can buy Matic against that ether, and so on and so forth. So you can do different kind of trades, both buying and selling. But throughout the process of trading on the centralized exchanges, your all the tokens are being held by the exchange itself. So you do not hold the tokens. And whenever you want to get a custody of tokens, there's a process to place a withdrawal request, and you place a withdrawal request, and then the tokens come into your wallet, non-custodial wallet. So that is typically how centralized exchanges work. And so important things to note about centralized exchanges, that they are natural extension of the stock market exchanges and other exchanges or marketplaces that we are used to. So that's why, from a user experience perspective, uh, still a lot of trading is done on centralized exchanges. But at the same time, major drawback is that you do not hold the custody of your tokens, and if exchange goes down, or if there are some corrupt practices or lack of discipline, etc., then your funds are at risk. And we have seen, starting Mount Gox, where major hack happened, to scenarios where user lost the keys, or there were various hacks at the management level, or the FTX scenario last year, due to some um, lack of discipline, or lack of best practices. The users' funds were at risk. So that is where decentralized exchange comes in. And since when we talk about tokens, we are talking about blockchain, and when we talk about blockchain, we are talking about a peer-to-peer decentralized network. We are talking about decentralized ledger, and how to reduce the role of intermediaries, how people can own assets, own tokens, whether it be NFT or fungible tokens. So decentralized exchange, of course, is something which is very much needed. And decentralized exchange is exactly the opposite of centralized exchange in terms of how it works. So in the case of decentralized exchange, you simply go to a platform like Uniswap, and you connect your wallet, and you can start trading. So there's no onboarding process. At every point of time, you retain the custody of your funds, so it's completely non-custodial. And so that's how it differs majorly from a centralized exchange. So the keywords are, it's non-custodial, so you retain your custody of your tokens, and there is no intermediary. Um, so and then decentralized exchange are based on smart contracts. So smart contracts enable the trading of tokens. Smart contracts enable to manage the liquidity within the exchange based on which the trading happens. And then there are various modules and features different dexes have launched that allow you to, let's say, restake, the whole concept of liquid staking, or you can, you know, there are different pools that you can participate in, on farms you can participate in. So vis-a-vis centralized exchanges, taxes offer complete transparency, because all the transactions are on chain. So whatever trading happens, whatever whatever requests are being placed, whatever liquidity is being offered or withdrawn, everything is on chain, and you can see the transactions on the explorers. So these are the differences. Like decentralized exchanges are peer-to-peer basis. Centralized exchanges are, there's an intermediary, an exchange, which basically manages the users as well as trading. In decentralized exchanges, often the KYC is not required. Some decentralized exchanges have come up which are providing trading of tokenized assets, etc., where KYC may be required. So partial KYC to full KYC. In the centralized exchanges, KYC is a must. In decentralized exchange is smart contract based, deployed on blockchains, and centralized exchange runs like a Web2 application, and they're more fragile to attacks. Um, Decentralized exchange is definitely scored less as far as user experience is concerned. So because you need to connect your wallet, if you're not very comfortable dealing in wallet, saving your seed phrase or private keys. So of course, decentralized exchange is not that user friendly for, especially for new users in the Web3 ecosystem. Centralized exchange, as I mentioned, are natural extension. So they use a Web2 interface. You can log in using your social auth and so on and so forth. And then decentralized exchange, the private keys or the tokens are remain in the custody of the users. In centralized exchange, it's completely owned by the exchange itself. And in terms of tokens, this again is a very interesting point. Centralized exchange has got a criteria which token would be allowed to be traded on a specific exchange. And that criteria, and they have different set of criteria, like the token should have sufficient liquidity, it should pass across their compliances, and so on and so forth. And that's why you'll see that in most of the newer centralized exchanges, you will find only 10, 20, 30 pairs. In some of the large exchanges like Binance, Coinbase, you'll find 300, 400 tokens or 500 tokens being traded. In the case of decentralized exchange, any token owner can come in and list their tokens. So that's why in decentralized exchange, you will find many, many more options. Pretty much, in fact, in last 2, 3 years, the major trend has been new token launches are focusing more on decentralized exchange. So they get often get listed on PancakeSwap or Uniswap, depending on which um, platform or protocol they are deployed on, rather than using a centralized exchange. So how does a decentralized exchange works now? So there are various mechanisms. This diagram pertains to an order book based kind of decentralized exchange. But the idea is simple. There is a buyer, there's a seller, and then there's a liquidity. So if you see, there are majorly three types today. One is order book based decentralized exchange. So that's how decentralized exchanges started. Where there's an order book, there are buyers and sellers who place the buy orders and sell orders, and the order book is created of buy orders and sell orders. And then there is a matching mechanism which match the orders. Um, Now, and this is how the decentralized exchanges started. But this model of having an order book and matching of buy orders and sell orders, it is broken in the sense that at times you have a lot of buy orders, but there are not sufficient sell orders to fulfill the buy orders, and vice versa. So the challenge is that when you place an order, you're not sure whether this order will be fulfilled or not, right? Because and sometimes uh, you are a buyer, but and there is a seller, but the criteria that you have put in, let's say you have put in a limit order that you don't want to sell below this price, or you don't want to buy above this price, but there may not be a seller or buyer to fulfill that condition. So these were some of the challenges in order book decentralized exchange. Some of the order book decentralized exchange, like again, there are options where some manage, you know, on off chain, and some are on chain order book. So on chain order book means all the orders are committed on the blockchain. So there are players like DYDX is one of the largest player, which works on an order book mechanism. It's off chain order books. And then there is GridX and Clobber and few other players who are provide again order book based decentralized exchanges, and they use on chain order books. Now, most of the decentralized exchanges, which are popular decentralized exchanges like Uniswap or PancakeSwap or SushiSwap, they are based on AMM. And AMM is a very interesting concept. The concept was that why not create a liquidity pool? So there's a liquidity pool in between, which has got both the, let's say you are trading in a pair, you want to buy USDT against Ether. So the liquidity has got Ether, it has got USDT both. And anyone can come and place a buy order or a sell order, and the order can be executed against the liquidity pool itself. So now it virtually it's peer to peer, but actually you're not dealing from order to order. You're not matching buy order with sell order. Uh, so it's called automated market maker (AMM) based DEXs, and it solves the problem of that your orders will be executed. Of course, there has to be sufficient liquidity in the pool. If there's no liquidity, let's say there are no sufficient USDT and only Ether are there, because sometimes it may happen that you started with equal number of Ether and USDT in terms of value, but there were more buy orders than sell orders, and the liquidity changes. So in that case, there may be challenges, but there are liquidity providers who continue to add to that liquidity according to the need of the pool. So that way, most of the time, you will find your orders get fulfilled instantly, and you don't face any challenges. You don't need to wait for a contra order to execute your transaction. And the most popular Uniswap was the lead in this regard. Uniswap is started with Ethereum, and then they extended to multiple EVM chains. Now Uniswap is we see Uniswap on Polygon, Avalanche, and some of the rollups like Optimism, Arbitrum, etc. And then PancakeSwap was started pretty much very similar to Uniswap on Binance ecosystem. And then, as I mentioned, you will find uh, at least one and most probably multiple decentralized exchange on pretty much all the blockchains, whether it be Solana or Avalanche or Cosmos or Substrate chains. And then third are DEX aggregators. So of course, wherever there is a marketplace, wherever there are buyers and sellers, there's an arbitrage opportunity. So DEX aggregators actually help the users. Like one inch is one of the leading DEX aggregators today. And now, if you have used MetaMask, you will see that MetaMask also, and if you try to use the swap function in MetaMask, you will see that it gives you different options, different rates. So that again is an aggregation function where, let's say, you want to buy a token against Ether, and you want to avail of the best rates, and the rates may be different across different decentralized exchanges. So DEX aggregators basically aggregate all the different liquidities and show you different rates, and you can select the best rate and execute the order. So that's how DEX aggregators work. There is Paraswap, but one inch is the leading DEX aggregator today. Now, so this is all good about DEX, but then of course there are risks and considerations. So one is a lot of decentralized exchanges have faced the challenge where smart contracts were hacked, and the liquidity itself was put at risk. So while trading on a decentralized exchange, normally you do not find any issue, because at every point of time during the buying or selling a token on the DEX, you hold the custody of the funds. As we mentioned in the previous webinar, the transactions are atomic. So if you start a transaction, if it does not fulfill, the whole transaction is reversed. So at every point of time, your tokens are not at risk. But then there's a liquidity pool which is behind the AMM based access, and if the smart contracts are vulnerable, they can be exploited, and the liquidity can be stolen, and that has happened for quite a few dexes. The second challenge, poor liquidity. Again, as I mentioned, there's a liquidity pool, and if the liquidity is not managed, sometimes there's only a buy orders and there's a poor liquidity. So especially when we talk about a specific pair, and that may result in slippage and poor user experience. Uh, Token bridging is another challenge that is basically challenge that today what has happened is, as I started this webinar with, that there are hundreds of protocols now, and there are a lot of EVM chains, a lot of layer 2 chains. And what has happened is, since these different protocols have propagated, the liquidity in the market has spread across these protocols, and that is where liquidity challenges come in. To solve this, a lot of interoperability standards came in. One of the earliest were cross-chain bridges. So bridges allow you to lock token on one chain and unlock token on another chain. For example, let's say you have USDT on Ether, and you are trading on an exchange which allows you to trade with USDT on Matic. So there's a cross-chain bridge through which you can lock your uh, USDT on Ethereum side of the bridge, and then it will unlock the USDT on the Matic side of the bridge. But the challenge has, and this solved the liquidity problem to quite an extent. But the challenge has been that these cross-chain bridges itself were quite vulnerable to attacks. And in fact, more than DeFi smart contracts, it is the cross-chain bridges that have been hacked in the last couple of years. But the good thing is that seeing these kind of challenges, a lot of new innovations have happened, which are much better than cross-chain bridges. Like Layer Zero is one such example. XLR is another example. So these are cross-chain protocols, interoperability protocols, and that are solving this problem where you can move liquidity from one protocol to another easily, and making these liquidity challenges obsolete. And then there are some challenges on decentralized exchanges being hosted on centralized servers, or if the underlying infrastructure is being run by one single player, there's not enough decentralization. And we have seen a recent case where failure of a centralized hosting provider actually led to a major hack. And then there are challenges of MEV bots, etc. Different arbitrage players, they try to extract maximum value, and they can exploit whatever inefficiencies are there. Sometimes DEX may become very expensive. Again, the problem happens when there is a skewed liquidity in the DEX liquidity pool, due to which DEX may become very expensive. And of course, these are decentralized, so support itself becomes a challenge in the case of centralized exchange. If you, let's say, lose your password, if you lose your two-factor authentication, your Google Authenticator key, you can still go to the support. They can help you recover it. In the case of decentralized exchange, since it's non-custodial, you're connecting using a wallet. If you lose your wallet keys, or if you face any challenges, there's no support available. And then DEXs may encounter scaling issues, but I think that's pretty much an issue of the past. Yes, decentralized exchanges which are hosted on Ethereum or other chains which have which may face congestion from time to time, you may find scaling issues. But now, if you talk about layer twos like Polygon and Optimism, Arbitrum, etc., or chains like Avalanche, which provides you 4,500 transactions per second. So there are a lot of blockchains now which provide you high throughput, more requests per second. You can process uh, almost instant finality, etc. So scaling issues are pretty much now being taken care of. DEX, has been growing in volume massively. So if you see 9 billion volume has been traded in the last 7 days, and if you see the like Uniswap being the lead with 4.9 billion, and then Pancake, and then various other Curve, Balancer, QuickSwap, SushiSwap, etc. So this was about decentralized exchange, uh, and I'm sure you may have seen or used or worked with one of the other dexes. Now we'll talk about DeFi lending. Now lending itself, and why I have clubbed together these two use cases, because both work on the liquidity pool concept, and from a concept perspective, it seems pretty cool. Because if you see from a transaction perspective, the transaction remains pretty much the same. In a case of decentralized exchange, you are giving a token and you are token taking another token back, right? Um, but there you are trading, so that means you are giving away your Ether and you are taking USDT. Now just imagine that you want to continue to hold your token. You have Ether, you do have and you do not want to sell them, but at the same time you want some liquidity, some cash right now. You may have an opportunity where you want to invest or take advantage of that opportunity. So in this case, rather than giving away Ether and taking USDT, you can simply give Ether as a collateral, and then you can borrow against that collateral. So that is what a DeFi lending. So lending is lending. DeFi lending is enabling this kind of lending or borrowing in a decentralized manner. So again, like decentralized exchange, the DeFi platforms, you can connect your wallet and then you can do the transactions completely non-custodial. You have complete control of your funds at all point of time. And so from that perspective, it's very similar to how the DEXs work. But right now, most of the DeFi are where collateralized lending we call, because you need to put in a collateral and then only you can borrow funds out of a DeFi protocol. So the concept here again is of liquidity pools. You create a liquidity pool. So in this case, the liquidity pool is between lenders and borrowers. In the case of DeFi exchange, we had liquidity pool between liquidity providers and then the traders who want to trade. Now, of course, in both the cases, if you find there's an incentive mechanism, in the case of decentralized exchange, whatever trading happens, a certain percentage goes to the liquidity providers. So that becomes their interest income of providing liquidity. In the case of lending protocol, it's pretty much works the same way. There are liquidity providers who are providing liquidity, and then they are an interest is accrued to that liquidity. And then on the other hand, you have borrowers who are charged a certain interest to take a loan, and part of that, a major part of that interest is given to the liquidity providers. So for the creditor, if you see from a lender perspective, so lender provides the liquidity into your smart contract. It's again the smart contract based liquidity pool where you provide the liquidity, and then borrowers can borrow against that, and they can borrow any kind of tokens. And on the borrower side, you can connect to a DeFi platform, you can connect your wallet, and then you need to put in your collateral, and against that collateral, you will be taking a loan. Now, there are some concepts like, if you're, let's say, giving Ethereum as a collateral, and the price of Ether today is, let's say, $1,800, or just, for sake of $2,000. And there is a collateralization ratio. That means that whatever collateral you deposit, whatever is the current value of the collateral, only a certain percentage of that value is the amount of loan that you can take. So let's say if the collateralization ratio is let's say 200%. So if you want to borrow worth $1,000, you need to deposit worth $2,000. Collateralization ratio is 150%. So if you want to borrow 1,000 USDT, you need to put in a collateral which is worth 1,500 USDT, right, or US dollars. So this is how collateralization ratio works, and this is very important and very easy to understand. The same concept that we see in the traditional finance also, the concept of loan to value LTV, because the price of Ether, your collateral can fluctuate. The market is volatile, the token may be volatile, and it may be possible that today you have deposited Ether which is worth $2,000, but then after 3 months it has come down to $1,600 or $1,800, and then your and if it comes below the collateralization ratio, then of course then you are actually not covered. Your loan is not covered by a collateral anymore. In that case, liquidation happens. Either you deposit the desired number of tokens or liquid or collateral into the smart contract, or your position will be liquidated. So this is how, and this again, the whole set of process is governed by the smart contracts, and that is the beauty of it. On the liquidation side, of course, there are third-party liquidators, which basically then liquidate this position and sell and settle it. So this is how typically the process works. That there's a borrower, there's a lender, and there's a DeFi lending platform where these lenders have deposited the liquidity. Borrower always deposit collateral, and collateral is required pretty much to ensure that the loan will be repaid. That is the major purpose of having a collateral in place. So DeFi lending has picked up very well. Some of the leading platforms today, Aave, Compound, these were some of the leading platforms, and today we see there are again like decentralized exchanges. You will find DeFi platforms. In fact, Aave like protocols have extended to multi-chains, providing support for multiple blockchain protocols, and similarly, each and every other ecosystem or blockchain protocol has got some or the other DeFi lending platforms. So this is basically a consumer lending process in bank and vis-a-vis a DeFi lending platform. So in a bank, we all have experienced some or the other loan. It may be a personal loan, business loan, mortgages, etc. So there's a whole drawn process where you request to a bank, you submit an application, you deposit all kind of documentation. Then there is a credit assessment phase. Based on a credit assessment, their decision is made to decide whether the loan can be given or not. If yes, then what kind of loan and at what loan terms it can be given. And then once the loan has been approved, disbursed, and then there is a whole collection process, right? Vis-a-vis that, in a DeFi-based lending, borrower can simply connect using their wallet. If you have, let's say, Ether, you can say that I want to deposit Ether as a collateral. Let's say the collateralization ratio is 70, 150% or 160%. Whatever you require, you need to pay as a collateral. You get the USDT or any other token that you are taking from the pool, and you can start using it. It's as simple as that. And whenever you return back the loan that you have taken, you can always withdraw your collateral back. So there is no intermediary required. There is no credit scoring required. Nothing. But yes, there is a drawback to this, and one of the drawback is that today, since the crypto market is highly volatile, and for that reason, the collateralization ratio is very high. 150, 160% is for liquid tokens like Ether and Matic. But if you talk about tokens which are not that popular, like Ether, Avex, or Matic, etc., the collateralization ratio may be 200%, 250%, even 300%. So that way, what happens is you may end up, depositing a lot more collateral to take a small loan, or you may not. The loan that you can get out of your collateral may not be sufficient to cover your needs. So that is, I think, one big challenge, and the reason is because there is no concept of credit scoring. Now there are various startups who are bringing credit scoring into the DeFi market, and once that get established, where basically unlike traditional finance, how the credit score based on your repayment history of the loans, if you're using a credit card, based on your historical data, your credit score is fine. Similarly, in the case of DeFi now, based on your wallet history, the kind of assets you hold, what kind of previous experiences with lending platforms, and so on and so forth. So again, it's going to be quite different from the traditional credit score. But yeah, it's a pretty good start, and it will help reduce the collateralization ratio in the case of lending platforms. And again, if in terms of challenges, I think challenges what we discussed for decentralized exchange are pretty much challenges when we talk about lending platforms. So user experience definitely is a challenge if you're new to the Web3 ecosystem, if you're not comfortable using your wallets. But here I'll make a special mention that user experience problem is still a huge problem. But yeah, a lot of um, newer options have come in, newer token standards, newer startups have come in who are trying, bringing in social logins and various other features, gasless transactions, etc., to make the user experience much better. Some of the popular DeFi lending platforms are Aave and MakerDAO. I think two of the most prominent early starters in this space. And then there are various other startups and Compound, of course. Venki is again a decentralized finance protocol built on Avalanche. They are Avalanche subnet, and they are again solving cross-chain liquidity problem. We have few other players like Meld, which again provides cross-chain liquidity. So a lot of players have come in who are trying to solve, either they are a lending platform or there are platforms which are enabling these cross-chain liquidity so that the lending and borrowing can take place much more seamlessly. So this is, I think, I wanted to cover as part of the deck. Now I'm open to any questions. Anyone has any questions, you can ask me.
Okay, so let me check the live chats in our streaming sources for a second. I cannot find any questions for now, but If there will be some, Ravi, maybe you can let us know what will be the next topic, the fourth webinar.
So as part of the DeFi series.
Yes.
Okay, so in the next webinar, I think since we have covered decentralized exchange and lending, in the next webinar we can continue the DeFi use cases, and I can talk about the next set of use cases. The rest of the use cases, there are the prediction markets, and there are investment products. As I mentioned, there are a lot of players like InstaDApp. So very exciting DeFi use cases that we can talk about. And I think special mention goes to real world asset tokenization. So since we talked about the lending protocol. So one issue that we talked about was that there's a higher value of collateral that needs to be given. Second challenge is that these are crypto collateralized lending. So that means you need to give crypto to take another crypto. So you need to put an ether as a collateral and get USDT, right? Just imagine on the other side, we are seeing a lot of innovations happening in the real world asset tokenization space. And as that market grows, we are seeing tokenized assets being put as a collateral. So if, let's say there's a real estate which is being tokenized, and and you own real estate tokens, now you can put these tokens as collateral into a DeFi platform and take loan against that. So now slowly and slowly we'll start seeing that it's not just crypto collateralized lending, but you will start seeing tokenized assets being used as a collateral to take loans on a DeFi platform.
Okay. Sounds very good and very exciting. I think that when we started talking about the use cases, it has become much more interesting about the DeFi, since not only theory but some examples. And I cannot find any questions for now. I think we have lost some part of our audience in the beginning, but I hope that will be okay since we are going to promote this video after we publish the recording on our YouTube channel. So please stay tuned. If we will get some new questions, Ravi, I will direct them directly to you, and maybe we will answer those in text. Thanks for being with us today. Thanks everyone for coming and everyone who is watching this. And see you on our next and last webinar dedicated to the DeFi series next month. Thank you so much. Bye bye.
Thank you. Thanks, everyone.